Welcome to this module. In this module, you're going to be learning about index fund investing, which is one of the most passive ways to earn residual income. What is index fund investing? An index fund is exactly as it sounds. It is a fund that is created to follow a certain index. You have several different types of indexes, such as the S&P 500, the NASDAQ, the Dow Jones. So those are several different indices that you can choose, and this fund actually mirrors the performance of that particular indice. Okay? So that can be very valuable because there are times where you can outperform what the actual market is doing. In order to get started with index fund investing, you have to choose a brokerage. So when choosing a brokerage, you want to look at the commissions on the investments that you are going to be using. You also want to look for brokers with a track record that is reliable and that they have been in business for a substantial amount of time. You want to pay attention to the account minimums. You have some brokerages that if you want to invest in an index fund, their minimum is $3,000. And then you have other brokerages that have a $0 minimum. You also want to watch out for account fees, because with account fees, that will actually be taken out of your overall profit. So you need to know what we call the expense ratio, right? Which is how much money you are going to be spending over time for this investment. You also want to look at the pricing and execution fine print. So you definitely want to read the fine print when you are getting involved with these brokerages, because you don't want to put yourself in the position to where you're constantly moving your money from broker to broker. You also want to consider the tools, education, and features that these specific brokerages have. You have some brokerages that offer a university style of learning and training, and they will teach you about different passive income investments as well as active income, as well as how to read the financial reports that you will be downloading for these specific investments. Diversification. Diversification is very important when it comes to index fund investing. Why? Because you are wanting to diversify your funds, which is why you are initiating this type of investment in the first place. So in finance, diversification is the process of allocating capital in a way that reduces the exposure to any one particular asset or risk. A common path towards diversification is to reduce risk or volatility by investing in a variety of assets. So, when it comes to index fund investing, let's just say that you have invested in the S&P 500. The S&P 500 tracks the 500 companies, top companies in the United States of America. That is extremely diversified, because at that point in time, you are not putting all of your eggs in one basket. You are not putting all of your eggs into one company. For example, let's decide that you wanted to invest in stocks, and you invested in Apple, and you put all of your money, $10,000, into Apple, and let's just say that Apple went out of business tomorrow. That means that you lost your investment. You lost that net worth that you were supposed to gain with that company. So that's why you don't want to take the risk, and you want to reduce your risk, liability, and exposure by not investing only into one company. You want to invest into several different companies, which is why index fund investing is actually very lucrative. So with the S&P 500, you are actually investing into the top 500 companies in this country, which is diversification at its finest. Because then at that point, you are investing into Google, Facebook, Tesla, you're investing into Apple, Berkshire Hathaway, all of the top companies in this country. So, with that being said, now if you took that same $10,000 and you are now put it into an S&P 500 index fund, then at that point in time, your money is allocated or spread it out accordingly to those 500 companies. And the thing that I love about a index fund is that, let's just say that a particular company goes bankrupt and it falls outside of that index, right? Let's just say that that company was, company number 400, they went out of business and now they're no longer a part of the index, right? So then at that point in time, what the index is going to do is that particular fund is going to now buy into that company that was sitting at 501, right? That company that was waiting patiently to get inside of the bracket of the top 500 companies or of the S&P 500. Okay? So that is something that I absolutely love, because that is something that you do not have to do. So when we say that this investment is passive, we really mean that it is actually passive, that you do not have to go ahead and start changing different parts of your portfolio in order to get it equally balanced. The index fund is actually going to do those things for you. Okay, so another thing with an index fund is that it is not managed. So that means that you are, in a sense, going to be making more money in the long run, because you don't have to pay a manager as you would with a mutual fund. Typically with a mutual fund, the manager will get anywhere between 1 to 2%, and that is compounded. So with this type of investment, it is not managed, so you are making more money in the long run because fees are not going to management fees. You will make more money in the long run because your money will not be going to management fees. Risk. So what are the risks involved with investing in index funds? So index funds are popular among investors because they offer a low cost way to gain exposure to a broad range of stocks. Like I said, you are going to be investing in the S&P 500, which actually gives you exposure to 505 shares of several different companies. And without needing active management, which is actually very important. Without active management, actually these index funds typically have lower fees, which actually puts you in that position to have lower risk because you are diversified, okay? And it requires less research in trading, so that means that you would be saving more money in the long term. So these index funds are very popular with investors because it actually allows you to invest in companies like Apple and Google, where you would normally have to put $2,000 to $3,000 per share. Now you get exposure and you get a fraction of the share with these specific index funds. By investing in an index fund, investors are especially buying a slice of the market. So with returns that match the overall performance of the index being tracked. So with the S&P 500, typically it does 8 to 10% per year, and you are actually getting, the top 500 companies in, the United States, but also the major companies like Apple, Tesla, Google, the big tech companies like Facebook, Amazon, right? So this type of investing can be very lucrative. It's 100% passive, and it is often considered a safe and reliable long-term investment strategy, right? You have billionaires like Warren Buffett and Ray Dalio. Both of these billionaires have mentioned several times before in the public that if they were to either start all over or in the future, what would they advise their families, loved ones, spouses to invest in? Their response was to invest in a low-cost index fund that tracks the S&P 500, and they would put their entire wealth into that index fund. So if Warren Buffett is telling you to do this, this is something that you might want to consider, okay? So as far as diversification, like I said, you are getting a slice of the pie for many companies, not just one, which actually puts you in that position of low risk because you are exercising diversification. But it is important to note that index fund investing still carries market risk, and investors should always do their due diligence before investing. So I'm not telling you that there's no risk. I'm just telling you that there's low risk. So now let's dive into asset allocation, which is my favorite thing. So what is asset allocation? It is when you allocate funds from your total investment into different asset classes within the same industry or in different industries, okay? So I have a very distinct form of asset allocation. So normally in my portfolio outside of index funds, my total investment, so it represents 100%, right? So I do 20% into real estate, 20% into index funds, 20% into my business, 20% into crypto, and then the other 20% will go into the foreign exchange market. So that is outside of this particular industry, which we're now talking about the stock market, right? So now inside of this industry or financial market, the stock market, we have a certain type of asset allocation that we go by, okay? And we're gonna dive into that right now. So you are, let's just say your total investment is $1,000. That $1,000 is going to represent 100% of your total investment, okay? Follow me on this. So now we are going to allocate a certain percentage of that $1,000 into different types of asset class in this industry. Okay, so let's begin. On the top, you see it says 30% of funds need to be invested in domestic index. Okay, so that means that 30% of your total investment, which out of $1,000 is equivalent to $300. So $300 would be invested into domestic indexes, okay? And later we will talk about these particular indexes, but I will tell you that according to a domestic index, you can choose any type of index fund that you would want, but for this particular one, next we have 30% of funds need to be invested in REIT index. So, what is a REIT index? It stands for Real Estate Investment Trust. So, it is actually a trust that is publicly traded on the market. And with this trust, its primary investment is real estate, commercial real estate. And so, those funds go to the shareholders or beneficiaries of that trust. So you get higher returns with a REIT. So 30% of your funds need to be allocated to a REIT index, which would be equivalent to $300. Next, we have 15% of funds need to be invested in international indexes. So that will be equivalent to $150. And with this type of index, it's international because we are practicing diversification. So all of your eggs cannot be in one basket or one country. So that means that if you are heavily invested in the United States, you also need to exercise diversification and risk tolerance by investing in other countries like China, Japan, the Middle East, Mexico, Canada, and other countries. Next, we have 15% of funds need to be invested in emerging market indexes. So that is also equivalent to $150. And with emerging markets, those are smaller markets that are outside of the international index. And usually that is of the Middle East, that is Taiwan, that is smaller countries that are up and coming, like countries in Africa. So with that being said, you want to understand that these emerging markets are building their infrastructure and they are, becoming very lucrative, and especially in oil and gas and things of that nature. So you do not want to miss the opportunities with these markets, okay? Some of the companies that you would find in an emerging market is Alibaba, AliExpress. Those are billion-dollar industries, but they are in locations that are considered emerging markets. Next, we have 5% of funds need to be invested in intermediate treasury bonds. Those are backed by the government and they tend to have lower returns, which is why we would only be allocating $50 to this type of index fund. The last asset class would be 5% or $50 of the funds would need to be invested in inflation protected bonds. And that is to protect you from inflation because inflation is constantly on the rise. So you want your dollar to remain the same value and not to depreciate when it is in these long-term investments. Now let's move on to what I consider the best brokerage of all times, Fidelity. So I did do a video within this course teaching you how to set up a brokerage account with Fidelity, as well as the reasons that you would want to invest in Fidelity. Okay, now what we're going to do is we are going to understand the asset allocation that we have, but for this particular brokerages, because like I said, there are many different brokerages. You have Vanguard, you have Charles Schwab, you have TD Ameritrade, and others. So you can do this investment strategy with any brokerage that you are currently with. And if you are not with a brokerage, then you would definitely want to sign up with Fidelity, because unlike other brokerages, Fidelity has a zero expense ratio, meaning that they allow you to grow your money absolutely for free and they do not charge you compared to other brokerages that have an expense ratio of 0.2 and so on. Other than the expense ratio being 0, they also have a 0 minimum deposit, meaning that you can start this type of investment with $0 compared to other brokerages that if you were to get into an index